Have you ever found yourself in a situation where you or your client accidentally deposited excess tax? It happens to the best of us, right? Well, getting that money back just got a brand new rulebook. Welcome to this explainer. Whether you're a chartered accountant, a tax professional, a business owner, or a CA student, you deal with tax refunds all the time. Today, we're diving deep into the crucial refund provisions under Chapter 20 of the new Income Tax Act 2025. We'll be looking at how the new act, along with the Income Tax Rules 2026 and the latest guidance notes, governs exactly how you get your money back.
Let's take a quick look at our roadmap for today. We'll start with an introduction to tax refunds, then break down the core legal provisions, look at some special cases, tackle compliance and forms, cover transition rules, and finally wrap up with a quick summary. All right, let's kick things off with Section 1, setting the stage for tax refunds.
So picture this. A taxpayer or deductor realizes they've overpaid. Maybe it was a simple calculation error or an incorrect challan was used. What happens next? How do you actually get that money back? Today, we're going to see exactly how the 2025 Act empowers you to reclaim those funds efficiently and, more importantly, within strict legal frameworks.
Moving right along to Section 2, let's break down the core legal framework, specifically Sections 431 through 438.
Okay, so Section 431 is basically your anchor here. Simply put, if you've paid more than you're legally supposed to, you're absolutely entitled to a refund of that excess. Section 432 then steps in to practically allow legal representatives to claim refunds on behalf of someone who is incapacitated or deceased. But here's the kicker. Section 433 establishes the baseline rule for everyone. To actually get your refund, you've got to file a return under Section 263. It's essentially the modern digital-first version of the old Section 239 from the 1961 Act.
Now, beyond just filing, there are two really important mechanisms you need to understand. First up, Section 438 allows tax authorities to set off, or adjust, your refund against any outstanding tax demands you might have. But they can only do this after giving you a written intimation. On the flip side, we have Section 435, which is a massive time saver. It automatically grants refunds following a successful appeal. That's right, if an appellate order results in a refund, you don't even need to file a separate claim. The assessing officer is legally required to grant it automatically. Let's jump right into Section 3 and look at some special cases, focusing on how Section 434 works in practice.
Section 434 is a really fascinating provision. It corresponds to the old Section 239A. It basically provides a safety net when a contractual agreement forces a payer to bear a tax cost that legally wasn't even applicable. Think about a cross-border transaction where an Indian business agrees to pay a non-resident net of taxes, meaning they absorb the TDS out of their own pocket. If they later find out that a double taxation avoidance agreement actually exempted that income, well, Section 434 lets them claim that exact money back.
But here is the catch, and it's a big one. You have an incredibly strict timeline to follow here as a deductor. You bear the tax, you realize the mistake, and then you have a highly compressed 30-day window from the date of payment to file your application. This is a strict compliance trigger that every single tax professional needs to be hyper-aware of. Okay, Section 4. Let's talk compliance and how we transition to the new forms under the 2026 rules. This mapping is vital for your daily practice. If you're still wired to the 1961 Act, it's time to update those mental models. Notice how the old Form 26B, which we used for excess TDS claims, is now completely replaced by Form 139. And the old Form 29D, for situations where no tax was deductible, is now Form 160. Make sure you get this right, because using the wrong form post-April 2026 is going to lead to immediate system rejections. Let's look a bit closer at Form 13.9. According to the latest guidance notes, this is your new go-to for duplicate deductions, incorrect challans, or overpayments. When you file this digitally, make sure you safely capture that system-generated acknowledgement number for tracking. And remember what we just talked about regarding Section 435? The FAQs explicitly confirm that you do not need to file Form 113 if your refund is coming from an appellate order. That whole process happens automatically in the back end. Now, Form 160 requires some meticulous attention. Because of that tight 30-day window we hammered on earlier, your internal systems really need to flag these situations instantly. Plus, the guidance notes highlight a very practical precaution. You must have rock-solid documentary proof of the written agreement showing you bore the tax out of your own pocket before you even think about filing. Moving on to Section 5, let's bridge the gap between the 1961 Act and the 2025 Act by looking at transition rules and common issues. If you're sitting there worrying about your pending claims from previous financial years, you can breathe a sigh of relief.
The CBDT's transition FAQ explicitly points out that Section 536 of the new Act guarantees your refund rights from the 1961 Act are fully preserved. So if you had a valid claim right before April 1, 2026, you still have it. Legacy claims, like an old Form 26B filed within its standard 2-year window, will be processed normally under the old rules. Here is a number you'll definitely want to remember: 1.5%. Under Section 436, if the government delays your refund, you're legally entitled to statutory interest at 1.5% per month or part of a month. This ensures taxpayers are actually compensated for the wait, so always make sure to factor this into your client reconciliations. Avoiding a few common misunderstandings here will save you and your practice an immense amount of time and frustration. The absolute biggest pitfall? Missing that strict 30-day deadline for Form 160. Another one is unnecessarily filing Form 139 after an appeal win. It just clogs up the system. And here is a quick pro tip. Before you go promising a client a specific cash refund amount, always check if the department has issued a Section 438 intimation to set off that refund against a past tax demand. Finally, Section 6. Let's wrap up with our summary and key takeaways. As you navigate the Income Tax Act 2025, just keep these 4 main pillars in mind. First, really understand the core framework of Sections 431 to 438. Second, fiercely respect the tight 30-day window for Section 434 claims. Third, update your office templates immediately to utilize the new Forms 139 and 160. And fourth, rest easy, knowing your pre-2026 legacy rights are completely protected under Section 536. So, I'll leave you with this thought to chew on. The law has officially changed, the timelines are updated, and the forms have been entirely renumbered. Are your internal compliance systems actually ready for this new regulatory landscape? Because right now is the perfect time to audit your standard operating procedures. Thank you for watching. Please like, subscribe, and share, and please note our disclaimer. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.